Root 7 things I wish I knew about investing before I started. So this episode is going to be super impactful. Stay right to the end because we're going to give away so much value. So we're going to supercharge your investing and become financially independent sooner. Imagine being able to avoid the common pitfalls that people make on their investing journey. This is what we're going to give away to you today. So imagine supercharging your investing. You're going to retire early if you avoid these mistakes. We're going to give away 7 of my favorite mistakes that I wish I knew before I started. I've been investing for over 20 years. I built up hundreds of thousands of pounds in assets that are building up, and it's going to pay me an income so I don't need to work anymore, or have the option to work. I can choose to go to work or choose not to go to work. I'm going to have assets working for me. This is property. This is money in the stock market, businesses that are generating profits. This is money that I've lent to governments or corporations that are paying me back. Essentially, this is free money. This is money made from investments. I'm getting paid dividends. I'm getting paid rent. I'm getting paid interest from my savings. And I'm going to show you how to do this today. We're going to give away 7 of the biggest mistakes I see people making, or the 7 biggest things I wish I knew before I started investing. So stay right to the end. Make sure you subscribe for more videos, press that like button and tell a friend. So number 1, we're going to get right into this. Number 1, you don't need to be a maths genius. There's a common belief about investing. You need to have some kind of special super mathematical ability. This couldn't be further from the truth. So I used to trade gas for Shell trading, and it used to be quite complicated. I had 8 screens around me. You had to know some certain maths principles. I remember being in an interview, and I was getting interviewed by an actual rocket scientist, and they gave me kind of these math puzzles, and that was trading. And I moved to financial advice, and it was kind of a breath of fresh air, because you didn't need to know complex mathematics. And this is brilliant. This personal finance, you don't need to know complex mathematics. Investing is simple, but it's not easy. So we teach you how to do this on my course, and we teach you how to do this in these videos. So basically, it's simple, but it's not easy. Personal finance, you don't need complex mathematical formulas. So the stock market is too complicated to predict. You can't have some complex algorithm that's going to figure out the stock market. You can't predict if the stock market is going to go up or down. You couldn't predict COVID. You couldn't predict the individual decisions made by billions of people around the planet. And this is why maths is an exact science. It's either right or wrong. With investing, it's totally different. There was an interview by Peter Lynch, and he talks about how actually his background in humanity, he studied humanities, he studied geography, he studied statistics. It was much more beneficial. So Peter Lynch was one of the greatest fund managers of all time. He wrote a book called Beat the Street and One Up on Wall Street, and he teaches that, so you don't need to have this kind of mathematical knowledge to be a good investor. So the simple principles of investing is your income comes in, minus your expenses equals your disposable income, and then you can invest that what's left over, and then you basically build that over time. Basically, you talk about, so you have what I teach in my programs, on my monthly meetups, is essentially have a mindful spending plan. So work out how much you're spending on your shelter, your accommodation, how much you're spending on food, how much you're spending on entertainment, and then take away how much you're spending on your income, and then you have something left over. Then set up a payment system, pay yourself automatically, so you don't need to think about saving and investing during your working day. Make it as simple as easy as possible. So one of the best formulas that I come up with is basically to say, or I haven't come up with, mathematicians who are much cleverer than I am come up with basically how to double your money, and it's using the rule of 72. I've done videos of this in the past, but it's basically one of my favorite mathematical principles ever. And basically all you need to do is work out 72 divided by the interest rate you're getting or your returns you're getting. So for instance, if you're put money in a bank at the moment, you can get 5% interest rates. So 72 divided by 5 is 14.4. And that is how many times it takes to double your money. So if you have £100, for instance, if you're getting 5% interest rates, it's going to take you 14.4 years to double that to £200. So it's all dependent on the interest rates you're getting or the return you're getting on your investment, your yield, some people call it. If you put it into bonds, you call that your coupon, basically your return on your investment. But that's a relatively safe investment. If you put money into a bank, it's cash in your pocket or cash in the bank is deemed to be lower on the risk spectrum. You can put money into the stock market and get a higher rate of return. So say, for instance, you're going to get 9%. So divide 72 divided by 9, and that equals 8. And that means 8 years your money will double at a rate of 9%. So if you're putting the average rate of the stock market is around 8-9%, so 9%, it's going to take you 8 years to double your money. So let's go higher up on the risk profile. If you're putting money in emerging markets, if you're putting money into growing countries, so smaller countries or smaller companies, if you're investing in kind of companies that are kind of more not so established, that are growing, maybe in not necessarily a startup, but kind of younger in their journey, so to speak, in the investment world. So essentially you're taking more risks because they're not as established. You might be getting, say for instance, 12%. So if you get, so 72 divided by 12%. I've got 12% in a year before. It's not actually uncommon if you invest higher risk. Higher risk equals higher returns. The Nobel Prize winning economist Sharpe figured it out. So 72 divided by 12 equals 6. So it will take you 6 years to double your money. And this is a mathematical principle. This is compound interest. It's a rule of thumb. I'm not saying this is going to happen every time, but it's a good way of basically calculating your investments if you understand how much return you're getting. Obviously, it's not guaranteed to get that return, but yeah, it's a good rule of thumb. So contrary to popular belief, investment you don't need to be a maths genius. It's not like about crunching numbers like a Wall Street analyst. So investing is simple, but it's not easy. And that's number one. That's the number one that I wish I knew before I started. So number one, you don't need to be a maths genius. In the 7 things I wish I knew before I started investing. So number 2 is start small and dream big. So investing is a longer-term game. So you're investing 10, 20, 30 years time for returns. And it can be quite daunting to think, actually, how am I going to get? We talked about these numbers. How are you going to double your money in 6 years, 8 years, 14 years? So it's a long-term game. And to understand this, simply all you need to do is put off short-term gratification and build up long-term gratification. So put away the short-term kind of needs you want. You kind of want that tasty donut now to eat it, but like that long-term effect of eating that donut, long term, you're going to put on weight. Maybe you don't feel good in a day or two because you're not having a nutritious, balanced diet. It's the same thing with investing. If you have a long-term mentality, this is going to put you in much better stead long term. So start small and dream big. So time is your greatest asset when investing. So the younger you are, the earlier you start, the better. So this channel is called Millennial Money Mindset. So millennials are 25 to 45-year-olds. And if you can start investing at 25, you're going to be so much better off than if you start when you're in your 40s or even in your 50s. You're going to have time. Compound interest is going to build up and work for you. You're going to have to be able to ride out these ups and downs of the market much better. So time is your greatest asset. Time is your friend with investing. So dream big dreams. So it's not something what is your goal? Have a dream. You need something to get you out of bed. You need I don't necessarily believe in SMART goals, where it's specific, measurable, attainable, realistic, and targetable. Have goals that are unrealistic. When I set up my company Money Tips 5 years ago, I never dreamed that I would have my own time that I can spend how I choose. I run my own business. I have courses. I wake up in the morning and people have bought books from me overnight from my company. This was a dream of mine like 5-10 years ago, and I wake up in the morning and it's a reality. So I say dream big dreams. Have a goal, have a target, have an end in mind, and actually go out. Don't actually limit yourself. Think, actually, it's a wonderful world we live in. Have dreams that you're going to surpass, that you're actually going to beat, that you're actually going to, you think that they need to be unrealistic. They need to be kind of challenging. If you're just saying that you want a promotion in 5 years' time, that's not going to get you out of bed each morning. That's not going to get you excited as you walk to work. That's not going to make you do the extra mile as you're building your company, or you're building your career, or you're building this investment portfolio that you want to. What are you building this investment for? Think long term. Is this going to free up your time to spend more time with your family? Are you going to be able to build a business like I have, because I've invested in my early 20s and when I was a teenager? This now means that my investments are working for me. My investments are working harder for me than I need to. And this gives me freedom. This gives me peace of mind. I'm not worried about the bills coming in, because I've got an emergency fund. I've got a safety net that's going to cover me for any emergencies. And this is a massive peace of mind. And this is what I'm trying to impart on you. This is why I start my channel. This is why I wrote my book, Millennial Money Mindset. If you want the fruits, you need the roots. This is why I've published 10 books. They're all available on Amazon and on my website, moneytips.org. So dream big dreams. That's the takeaway. That's what I try to talk about on my book, Millennial Money Mindset. So time is your greatest asset. So think about actually what is an asset. Asset is something that puts money into your pocket. So you want to be buying assets that are going to be paying you an income, so you don't need to work. The aim of the game is to have an automated a bag of assets that are going to work for you. This could be property, this could be money in the stock market, this could be bonds, where you're lending money to people. And every year this generates profits for you. This generates income for you, so you have the option to go to work on a cold December morning, that you can wake up, you think, actually, I don't have to go to work. I can go and do what I want with my life. This is the goal of investing. This is why I'm trying to teach you and to explain why investing is so brilliant, and why you should start investing as soon as you can. That's number 2. So dream big dreams. Start small, dream big. So number 3 of the 7 things I wish I knew when I started investing over 20 years ago is savings rate is more important than the rate of return. So what do I mean by this? So the amount you save is going to be much more important than your return, your annual return. So in the media, in a lot of social media, there's a big thing about like Bitcoin to the moon, or put £1 in and get 200 returns, which are unrealistic. But the actual what as a person at home, what you can control and what you can't control. This is really important to understand. So understand what you can control and focus on that. So what you can control is how much you save each month. So you get paid at a job, that money comes into your bank account. How much of that money gets saved? How much of that money goes off into an emergency fund? Or how much that money goes off into a savings account? How much of that money goes off into investments, into the stock market? Maybe you're building that savings, that bank account. Maybe that's putting money away to build a deposit of a house that you want to buy, a family house that you've always dreamed of buying. That's your savings rate, and you can control that. You can increase your income, so you can ask for a promotion, you can change jobs, change companies and go for a higher salary. You can have a side hustle. You can do turn your passion into profits. And on a weekend, you can sell cookies because you love to bake. You can go to a jumble sale and sell unused clothes that you know, or kind of computers that you no longer use anymore, or kind of the bike that you no longer use anymore. This is income. You can increase this income. So income coming in, and you can reduce your spending going out. So you can reduce how much you spend. You can move somewhere cheaper. You can get a lodger in to maybe that's not reducing your expenses, that's increasing your income, but you can move to a cheaper area. You can cycle to work rather than driving to work. You can buy a cheaper car rather than buying the new Tesla that's going to cost thousands of pounds. This is reducing your expenses. It's not sexy, it's not glamorous, but it's going to get you closer to financial independence, where you are your own boss, where you are the master of your own desire, and you are free to choose how to live your life. And this is the goal. This is the key. This is the goal. This is the aim of the channel, to become financially independent and retire early. So your savings rate is more important than your rate of return. So the aim of the game is to capital appreciation. So the more you save, the more this capital pot, this pot of money, builds up, builds up, builds up. And it's like a snowball building up over time. And if you can save each month, then you're winning already. So focus on what you can control. So focus on your income, focus on reducing your expenses, and do a bit of both. So rather than focusing at the start on the rate of return, don't necessarily focus on buying the top stock, trying to buy the new kind of tech startup that you think is going to make loads of money. Focus on your savings rate when you're starting out. This is going to save so much time, so much effort, so much energy. If this makes sense to you, press the like button, press subscribe. My name is Neil Doig. I'm the founder of Money Tips. We educate and empower you to make better decisions with money, to get you financially independent and retire early. So number 4 is automation is key. So much of my life I wasted doing manually tasks that I didn't need to do. And automation means you can do less work. Who doesn't want to do less work? Why would you do more work when you don't need to do it? So automation is key. We live in a world of technology. The technology today is amazing. It's so much better than when I started investing 20 years ago. My first investment I made was lastminute.com during the dot-com boom and bust. And I had to physically write a check to, if you ever remember these paper checks of how to transfer money, I had to write a check, physically post it in the mail, go to the post box, physically post it out. The mailman would have to, or the mail person would have to collect it, send it over to the stockbroker in London, and then he would have to post back my share, my share ownership, where it was a piece of paper that proved that I had bought this share. So that was 20 years ago. Today it's so much easier. You, at a click of a button, literally click of a button, you can buy a fraction of a share for £1 up to £10. It's tiny amounts that you can do today, and you can automate this. So rather than having to at the end of the month think, oh, I've got to put some money into my savings, I've got to walk to the bank. Imagine that. In the old days, you have to walk to the bank with a sack of money and have to hand that money over to a bank clerk, and then they would count it all up. Then they would transfer their money. They would put that money in the safe. Those days are over. You don't do that anymore. Just automate it. Just set up a standing order every month that puts your money from your main bank account into a savings account. So if an emergency fund, or if you've done that already, if you've paid down your high interest credit card debt, then start investing into the stock market. It's so easy. It's never been easier. And it means you do less work. It means you manually don't need to do this. It's going to mean a massive burden off your mind. You're going to have you're going to have that burden of that stress lifted from you because it's automatically done. So I watched a YouTube video years ago telling me to do this, and I'd followed the instructions, set up an automated payment system, a standing order or direct debit from my account into another account or into the stock market. And I've done that every month for 20 years. without fail. And it just builds up over time without me thinking about it. If I hadn't done that, then I would have tried to do it manually. I would have forgot to do it. Other things would have been, life happens, life gets in the way. I would have gone, forgot to transfer money some months, or transferred less than I should have done. I would have, spent more than I was meant to. I would have had less in my bank account, and it would have never got done. But because it's automated, it happens automatically without me thinking about it. And it actually means that you're more likely to get better returns if it happens automatically, because you overthink everything. We humans are so bad at investing. We're not wired to be good investors. We're wired to, from thousands of years of evolution, to eat the tasty snack when we have it, rather than think actually 10, 20 years ahead. So by automating it, it means that we're not overthinking. We're not trying to time the market. We're having time in the market. We're not trying to time the market and getting it wrong. We're going to lose money over time. And this has been proven time and time again in research. So automate it, and it means you're not trying to time the market. It's just happening automatically. And the great thing is, when the market's high, because you're putting the same amount of money in, you're buying less units of this asset. You're buying less units of shares each month. And when the market's low, you're buying more units of assets every month. And that means it's called pound cost averaging, or dollar cost averaging, and it averages out better. So you're buying assets when it's high, less assets, and when the market's low, you're buying more assets. So although it sounds counterintuitive, you're doing better when the market's high, and you're buying more when the market's low. So you're getting more bang for your buck. You're getting more money in your pocket for the long term, rather than trying to time the market. And the third thing, it's going to reduce your stress and worry massively. If you're not worried about the time, you're not worried about, oh no, can I time the market? Oh no, the market's crashed, what should I do? Oh no, this stock that I bought, it's just had a profit warning. You don't need to worry about this, because it's happening automatically, and it's going to save you so much stress and worry. If I'd known this when I started 20 years ago, it would have saved me so much hassle. It wasn't even the tools to do this wasn't even available. This is how lucky that we are today. The technology is amazing, that you need to utilize these tools and make life easier for yourself. So please do this for yourself, and hopefully at least one of you watching this does this automatically, sets it up now, do it now on your bank account, and then you don't have to worry about it ever again. And if you look back in like 5, 10, 20 years time, you're going to have a pot of money sat there. You haven't even thought about it, and it's going to be there churning away. You're going to have interest on interest, and you're going to have building up this capital. And this is the kind of the secret of investing. Build up this capital and interest on your interest. And as that capital grows, you're going to get more money back in your pocket. And this is the aim of the game. This is the aim of this channel, to get more money in your pocket, more time in your day, and more happiness in your life. How much happier will you be when you see that pot of money in 10 years time, 5 years time? How much happier you will be, because you'll free up your time. You don't need to go to work. Maybe you can retire a year or 2 years early. You can get out of the rat race, commuting on the train, on the tube that you don't want to do each morning, waking up on that cold February morning, having to get out of de-ice your car. You don't need to do that if you're financially independent. You have the choice to do that. And this is what we're working for. This is what we're striving for. It's simple, but it's not easy. And that's number 4. Automation is key. So you might be asking, Neil, what do I automate? What should I buy in the stock market? This is number 5. So index and chill. So if I was just starting out today, if one of the things that I wish I'd known was about index funds or index trackers, and all this does is buy a small part of every company in an index. So an index could be, say, the FTSE 100. So the FTSE 100 is the 100 biggest shares in the UK. And you can buy a FTSE 100 tracker, which just tracks the 100 biggest shares in the UK. Or alternatively, you can buy the S&P 500, which is the American stock market. And this is the 500 biggest companies in America. And you can do this in any country. You can do this in the Italian, the Spanish stock market. You can do it in the German stock market. You can go bigger than that. You can buy the European stock market. You can buy the global stock market. And this is thousands of companies all around the world. So I love the global stock market because it buys big companies, it buys small companies, it buys developed countries, it buys developing countries, and it gives you a whole diversification of different companies and different countries all around the world, all different types of companies. So some companies do well in a downturn. So for instance, utility companies, people still need to buy, food, people still need to drink water, people still need to have medicine. They tend to do good in recessions, whereas other companies do better in kind of boom times. Tech companies tend to do better in kind of massive growing markets. So this index buys a basket of all these, just think of it like a basket of all these different companies all around the world, and you just buy one for one click of a button. You can buy hundreds, if not thousands of companies all around the world, and you just need to index and chill. So one click does this automatically every month. Simple as that. If you want to get even fancier, put it into an ISA, individual savings account, stocks and shares ISA, and you're going to save tax as well. So that's even a little bonus there that I wasn't even planning to give away today. So you're not going to be kind of an exciting chat at a house party. If you go to a party and say, what are you investing in? And you just say, oh, I just buy into the index, the S&P 500 or the FTSE 100 or the global index tracker. This is not going to be as exciting as if you've just bought the local AI stock or the cannabis stock, or found a new cryptocurrency that's going to go to the moon. It's not as sexy, it's not as exciting, it's not as kind of fun as some of the other conversations. If you're buying individual stocks, you get this kind of emotional attachment when you buy individual stocks, and with that upside comes a downside. So you get attached to these individual stocks. If you buy Microsoft and then you see Bill Gates saying something silly, or you buy Tesla and you see Elon Musk coming out with something silly, or buying Twitter when it doesn't make sense to buy Twitter economically, and then this could affect the stock price of Tesla. It could affect the stock price of Microsoft, or another example is Facebook or Meta. Mark Zuckerberg can come out and say something silly, or it's going to affect the stock price. But if you diversify in an index, it's going to save that risk. You reduce your risk of counterparty. You reduce counterparty risk when you buy indexes. You're buying thousands of companies all around the world, hundreds of companies all around the world. So some do good, some do bad, and they balance each other out. So that's number 5 that I wish that I knew about investing before I started 20 years ago. So number 6 is investing is a skill. So investing is a skill, and it gets better over time. So don't get stressed out if a lot of words don't make sense initially. So if I say the FTSE 100 and you're like, Neil, what's the FTSE 100? Or if you hear the S&P 500 or what's ETF, these acronyms, like anything, all of this that sounds strange and unusual, but but you're going to learn this over time. Don't get stressed out about it. The longer you invest for, the better you get. Come along to meetups. We have a meetup. My company Money Tips has a meetup every month at the last Monday of every month. So we're basically we meet up, we talk about investing. I give a presentation. What I've been doing is giving a chapter of my book each month, my book, Millennial Money Mindset. And we answer questions, we network, we talk about investing. And essentially the aim is to improve your investing for the long term. So we've got a group of like-minded people, and places are limited. I'll link a link below, or go on my website, moneytips.org, and you can find the events that we meet up with. And essentially, it's a skill. You're going to learn. Investing is a skill, and you're going to learn through time and practice. So you're going to get better through practice. It's like riding a bike. You're not going to pick up riding a bike initially, but the more you do it, the better you get. You're going to learn skills, and concepts that I'm talking about on these videos might not make sense until you actually physically do it. So I'm talking about automation. You might not, in one of my points earlier, you might not understand how beneficial it can be until you do it. And you're like, oh yeah, that makes so much sense, Neil. Thanks for telling me that. Or I might talk about how the savings rate or starting small. It's not going to make sense until you actually start. So experience is the best teacher. You're going to learn so much more through experience than you are through theory, through reading books. Although books are amazing, like my book, Millennial Money Mindset, check out the book. And I've created a card game. So you can play and learn through cards. You can learn through play. About the stock market, it teaches you how to invest in 6 minutes. The card game is called Football Formation Asset Allocation, and it makes everything easier. So it takes time, it takes practice. You can actually learn from mentors. You can learn from people who have done this before. And like today, you're learning from my mistakes. I'm teaching you how to avoid these mistakes. If you learn at least one of these, pick one of these skills and avoid them, and you're going to get this is going to save you years of having to invest. So if you take any of these skills that I'm talking about here and apply them and put it into your life, this could shave off 1 year, 2 year, 10 years of working at a job. By doing this, you're going to create more assets that are paying you an income, so you don't need to work. So you're going to escape the rat race quicker by learning from me, because I've done this. I've done this 20 years, and you're going to learn about this quicker. It's going to speed up your journey. It's going to save you loads of stress, and you're going to save money as well by avoiding these complex or silly mistakes that I see people making time and time again. You're going to do this because you've learned from my mistakes. So everything is new. Everything takes time. So just get in the game, start learning, take my course, and it's a step-by-step guide. You can take it while you're starting to doing your research. You can take it as your first investment. I have on my members area, I have a menu of the best investment platforms available. We rate them. I've used most of them, and some of them are great, some of them are terrible, and some of them are expensive, some of them are really great value, and there's some good ones and some bad ones. So by being a member of Money Tips, you're going to have access to these resources. You're going to have access to these investment platforms that you might not be aware of. You're going to have access to, we've got calculators on the members area, and it's going to save you time, it's going to save you stress, and it's going to save you money as well. So if this is helpful, press that like button, subscribe to this channel. This is Millennial Money Mindset. We're on YouTube, we're on podcast, your preferred podcast channel, and we're also on TikTok, Money Tips on TikTok. So please subscribe, please like, and please tell a friend. This really helps us out, and it helps us beat the algorithm and get better videos into your inbox, into your view, for your viewing pleasure. So, and finally, before we have number 7, let's go through the 6 in the past, the six things I wish I knew before I started investing. So number 1, you don't need to be a maths genius. Just remember that compound interest calculator, the rule of 72. It's amazing. It blew my mind when I first knew this rule of 72. It's one of the best hacks that I've come up with on my investing journey. I'm a money coach, and I help make money simple, easy, and achievable. So number 2 is start small and dream big. We're talking about retiring early in 10, 20 years time. It seems daunting, but start small. Take one piece of action. Take one item that I've listed on these 7 and apply it. You put it to your daily life and automate it. Make it simple. That's number 2. Number 3 is savings rate is more important than your rate of return, especially when you're starting. So start saving, start getting to that savings habit and building up that capital. And one of the hardest things, it's not about actually automating your saving into a pot of money. It's actually not touching that pot of money. You're going to want, that desire is going to rise up in you. You're going to want to buy a new Tesla. You're going to want to go on that new flashy holiday. You're going to want to buy a new pair of shoes. When you see that you've saved this money, you're like, wow, Neil, I've saved this money. Why don't I spend it? Money's for spending, right? No, it's not. You need a pot of money that's purely there to build up capital appreciation. And the reason you're doing it is because once you have that pot of money, that pot of money will start working for you. That pot of money will start generating income for you, and that pot of money will start working harder than you do. And this is going to mean that you're going to be able to retire early. You're going to have financial independence, and you're going to have your own, it's going to give you that financial freedom. So number 4 is automate, saving, automate your investing, automate paying off as much as you can. So it means you do less work, it means you have less stress, and it means that mathematically you're going to have more time in the market. You're not trying to time those ups and downs in the market. It's going to be automatically, and it's going to save you time, stress, and money. So number 5 is index and chill. If you're starting out and you're trying to think, Neil, what stock do I pick? What index? I want to pick the best stock that's going to go to the moon. Just index and chill. Just pick the global index tracker. Pick the FTSE 100. Pick S&P 500. Or there's plenty of great platforms that you have a basket of stocks. Don't try and pick individual stocks. That means you're going to reduce your counterparty risk, and it means you're going to get more money in your pocket, because you're not going to be losing money trying to pick and time the market. That's indexing. It may be more boring, but it's going to get you to financial independence quicker. So number 6, investing is a skill. Remember that. Don't get stressed out. It takes time, it takes practice, and it takes knowledge. You'll learn from other people. Learn from me. I do one-to-ones as well. If you want to speed up that journey, then sign up in my website, moneytips.org, money tips with 2 P's. I'll link it down below. And yeah, it takes practice. Don't get too stressed out about it. So number 7 is of the skills that I wish I knew is embrace the thrill. So I love investing. It's one of my favorite things to do. It's probably one of the best things that I'm good at or one of the only things that I'm good at. I would make a terrible nurse. I'd make a terrible policeman. And I'd probably be, I don't know, something else that I wouldn't be very good at. A surgeon. I don't think I would like the sight of blood. But for whatever reason, I feel like investing is my home, and I've built up over time my own investment portfolio, and I've built to love it. So it can be complex, it can be simple. It depends on you. Pick your own style, pick your own speciality, know your strengths. Number 1 was you don't need to be a maths genius. If you are a maths genius, you can use that to your advantage. You can start coming up with complex formulas. I studied geography at university, and I used that strength. I love to invest in countries all around the world, looking at developing countries and seeing which ones are underpriced and undervalued. And that's where I have found my best results as an investor, because I found my strength. And that's exactly what you need to do as well. So find your strength. If you like investing in property, maybe you find out get drawn to. So invest in property. If you like the stock market, get invested in the stock market. You might really find currency and technical analysis really interesting. Then start investing in currencies, become a currency trader. So life gets better when you get better. So start improving. Think of it like continuous education. Just like compound interest, your knowledge compounds. Each day you get better and better and better. By watching these videos, you're going to pick up little bits of nuggets of information that if you take and apply, they're going to exponentially improve your life. You're going to get more happiness in your life, more money in your pocket, and more time in your day. So yeah, learn how to learn as well. Learn how you learn. We all learn differently. Some people learn through videos, some people learn through reading, by trying to be as active as possible. So you're going to learn much more if you're active, if you're actually practicing, if you're actually in the game, if you've got skin in the game in investing, then you're going to learn much quicker. That active learning is going to kind of supercharge your investing knowledge. So yeah, pick the part that you like. If you don't like picking individual stocks, don't do that. Just pick an index. If you love picking looking for property, do that. That's a great thing about investing. If you want to save loads of money on tax, then understand pensions more. Pensions are a great way to save money on tax, and life gets better when you get better. So the more you learn, the more you earn. Yes, that's the video for today. Please like, please subscribe, and please tell a friend. My name is Neil Doig. I'm the founder of Money Tips, tax, investment, property, pension, savings. Come over to our website, moneytips.org, tips with 2 P's. We've got a whole wealth of information, loads of resources on the website, and we've got even more access, even more resources on our members area. And members area pays, it costs from little as £1 a day. So join up as a member, come to our meetups. We meet every month. Yeah, what did you like about these 7? Which of the 7 was your favorite? Write in the comments. Or which would you add? Anything that you wish you knew before you started investing? Anything you don't agree with? Yeah, write in the comments. Let's start a dialogue. Let's start a conversation. Let's start a chat. I like investing as much as I said. I love investing. It's one of my favorite things to do. And yeah, let's start. I can teach you loads about investing because I've been doing it myself. I've made loads of mistakes over the years. So hopefully that's been useful. And yeah, so yeah, my name is Neil Doig. Please like, please subscribe, and please tell a friend. Thanks so much, and see you again.